Hello, welcome everyone. We are going to have an absolutely fascinating discussion on really cool asset class and really interesting strategies to supplement what family offices have been doing. And I would like to kick off by introducing our panelists. Let me see where you are. Okay, so Bill Timmerman is the managing director of
Xnergy. It's Xnergy Synergy.
Xnergy. Great.
Synergy, just call it.
That's perfect. Zack, Ellison is the managing general partner at Applied Real Intelligence, A.R.I. And we also have Shant Sood with us, managing partner and co-founder of Sanctum Capital Management. And I'd like to ask you to start us off with a view of the macroeconomic environment so that we can talk just a little bit about macro and then go down to your individual strategies and then discuss how you're different and you know what you contribute just based on your experience and what we've seen on the markets. This is a very experienced, highly experienced panel. Bill, do you want to start with kind of what you're seeing?
Okay, no problem. I'm Bill Timmerman. I'm managing director at Xnergy Financial. We're a federal regulated investment bank. I would call it a boutique bank in that we deal on the lower middle market. Lower middle market, we're raising funds, debt, equity, leases, venture debt for my friends on the panel, and also doing mergers and acquisitions for companies ranging from the A round, the VC companies, basically, up into maybe 20 million of EBITDA. So it's the lower end, we're dealing only with entrepreneurs. Even the couple of public companies we've had, they've always been very entrepreneurial. And what we have to, I think, offer for family offices, it's a view on everything that you don't see on the Standards and Poor's, if you will. It's deals that are hidden away. You wouldn't find them otherwise, except through investment banking, unless you were dealing, you had somebody else marketing for you. So we bring all types, and that's credit and equity type of deals to people for their looking at them, at least they see it. What we see in the market is for the companies today, it's extremely hard to raise funds. And we have customers that we go to, many investors, but it's they're very much more difficult than they were 2 years ago. Obviously, valuations are much lower than they were 2 years ago also. And that's throughout from the A round all the way up to people with $20 million looking for buying, selling, or just raising growth equity or growth debt.
Thank you, Bill. Zack, what is venture debt? Can you talk a little bit about this asset class, and also why is it white hot at the moment?
Sure. Yeah, just a brief bit about my background, because some people might not know who I am. So started in fixed income about, I don't know, 18 years ago or so. I've worked at 3 different trillion-dollar firms, banks and asset managers. Scotiabank, where I was an underwriter of TMT loans before the credit crisis and during the credit crisis, where I managed $2 billion of a $6 billion book and worked on some of the biggest media deals at the time, and also experienced a lot of workouts and restructurings during late 2008, 2009, 2010. So I got a lot of credit experience there. Went back to business school at University of Chicago for my full-time MBA, studied analytic finance and economics from a couple Nobel Prize winners and some others. Then went to Deutsche Bank, where I was a bond trader and CDS trader at 60 Wall Street, back when we were the biggest bank in the world with 2.8 trillion assets. So had a massive balance sheet there. Then went to Sun Life, which runs about $1 trillion plus in assets, biggest private investor in Canada. And helped run a $25 billion corporate credit portfolio, actually 70 different portfolios rolling up to about 25 billion. Had excellent performance there, beat the index every year handily. And then went back to get another master's in risk management at NYU Stern. Did the CFA charter, the Kaya charter. I'm on the board of both CFA and Kaya in LA. West Coast Regional Director for the Hedge Fund Association, a Milken Institute member, and now I'm working on my doctorate in business at University of Florida, hence the hat. I'm actually in St. Pete right now. I was just in Gainesville this weekend watching them beat UNC Charlotte in football and spent about 25 hours in class. And I'm doing my dissertation actually on funding innovation, mainly venture debt, working with the head of the finance faculty at Warrington College, who did his PhD at University of Chicago under Eugene Fama. So anyway, that's my lineage. Saw this huge opportunity in venture debt. Venture debt really is making loans to VC-backed companies. And these companies are typically generating revenue. Not always, but most of the time, at least the way we will be doing it at A.R.I. is companies that are generating anywhere from like 10 to 100 million in revenue, is kind of the range. These are great, this is a great asset class. So forget about what I do, just think about the asset class. Somebody should mute themselves. There's like a lot of noise in the background, but yeah, so essentially think of it as floating rate loans, typically going to be senior secured at the top of the capital structure, oftentimes the only debt in the capital structure. So from a risk perspective, right off the bat, you don't have interest rate risk, right? You're hedged against that because they're floating rate loans. You also, of course, the company has risk, but as a senior secured lender, you're sitting at the top of the capital structure. So you have the least risk in the capital stack. These loans typically are yielding a mid-teens return. You get equity warrants in the majority of deals. So you not only get, steady, mid-teens income, which is very attractive to folks, but you participate in the upside of these companies as well. So if some of them do wind up getting bought for large amounts or going public, the equity warrants can provide, asymmetric upside, which you would not see with almost any other, debt product. So you've got like a lot of really interesting characteristics that make it very unique. And the reason and Shant is an expert in this as well and has done this longer than I have. So he'll have a lot of things to say about, how you de-risk venture debt, why it's so attractive. But the last thing I'll mention, Julia, to your question about why it's, white hot right now. First thing is, everybody on this call knows that private credit is red hot, right? Everybody wants to be in private credit. It's generating, excess risk-adjusted returns. It has for quite some time. It's well positioned going into this next phase of the cycle. But within private credit, which is where venture debt slots in, venture debt is unique because it's got very low correlation to other asset classes. It's got these unique risk characteristics that I just talked about, like floating rate loans, senior secured, great equity sponsors, asymmetric equity upside through the warrants. And the big thing is, in terms of the catalyst that we've seen recently, was Silicon Valley Bank going out of business, you're collapsing on March 10th. And that had nothing to do with their venture loan portfolio. In fact, that was the jewel in their business, and that remains so in hindsight. But they didn't know how to manage their interest rate risk. We've gone over that previously. So they blew themselves up with the quote risk-free mortgage-backed securities and treasuries because they didn't know what interest rate risk was apparently at the top of the house. So that's a whole nother story, but kind of laughable in hindsight. But anyway, they got bought by First Citizens. First Citizens, never had a footprint in venture debt. I think personally, and I've said this multiple times, that their footprint, when all is said and done, will be probably 20% of what SVB's was at the most. When all is said and done, 5 years from now, let's say. What this means for people that don't know the space is that SVB was the largest lender by orders of magnitude. They were over 50% of the market share over the last 20 years. They had a very unique business model, which enabled them to do that. So now you've had the biggest capital provider in the debt space pulling back. And concurrently, on the equity fundraising side, it's incredibly challenging. Anybody that follows VC or has a portfolio company knows that equity is incredibly expensive right now. It's incredibly hard to get VCs to open their wallets. Valuations are way down, which is why the cost of capital is so expensive. And it takes a long time to get a deal done. And the deals are smaller. So if you're trying to raise equity capital right now as a founder, you're up against it big time. It's harder to raise capital now than it has been in probably 20 years. And it's also coming off a period where it's very easy to raise capital. So the difference in the environments is stark. It's like being in like a hot steam room and then jumping into an ice pool. I mean, it's that
It's a
different.
cold shower, right?
Yeah, big time. And so as a lender in the space, it's an incredible opportunity because you've got so much demand for capital, and then the supply is relatively limited. And if you think about what makes an investment good, it does not matter what asset class it is. It's all about supply and demand. When there's more demand for something than there is supply, the price goes up. You've seen it with shitty assets like cryptocurrency that aren't even a real asset, that were worth a lot because people said there's limited supply, there's finite supply, and people bought into that nonsense. But so think about that. If you can take an asset class that's literally worth zero and make it worth trillions because it has finite supply, imagine what you can do with a real asset that produces real income backed by real companies and the best VCs. So suffice it to say that, and I'll stop in 10 seconds, demand is much greater than supply. The people that can supply the capital and do it wisely and be selective, and that don't have a balance sheet that's torn up by bad deals done in 2020, 21, and 22 are going to absolutely make a killing, just like private lenders did coming out of the GFC.
Zach, I have a question. So if I can just jump in real quick, just a follow on. So you said, I forget the name of the bank that bought SVB. Who was that again?
First Citizens in North Carolina.
So is First Citizens going to be lending at the same terms as SVB?
Well, I mean, generally they are. I mean, they are making loans. I mean, and they'll
Are they at the same terms?
Yeah, rough. Well, in the sense that they're market terms for bank loans. So bank loans typically are priced off of prime rate plus a spread of 50 basis points to call it 150 basis points is kind of like the average. So prime now is roughly 8.5%. So these loans are pricing at 9% roughly. Whereas when prime rate was at 3.25%. SVB was actually making loans below prime in some cases. So they're lending at 3%. Now they can lend at 9%. In the bank loan.
And the typical venture debt loan is at prime plus 15?
No, much tighter than that. So and Shant will know this as well. It ranges, but I would say if you're using prime as your benchmark, it's going to be 4 to 8% spread on that. So call it like 12.5 to probably 16 roughly.
Okay, great.
The cash pay can't go up much, in my view, and what I've seen historically is when the cash pay gets too high, it starts to become painful to the company, right? Because these are companies that are very cash sensitive. So you don't usually want to see the cash pay above the mid-teens. But that doesn't mean you can't get paid more and earn more as an investor. It means you can get more equity warrants, lower strike price. You can also take PIK interest. And there's also other structural features you can build in to juice your return. So it's not that your return is capped, but your cash pay typically isn't going to go much beyond like 15 or 16% with any good company, in my view.
This is an awesome overview, and I like the whole supply and demand because it frames it very nicely as far as the dynamics of the market is concerned. Shant, I want to come to you for a second. Tell us why you decided to be the co-founder of Sanctum Capital. Can you tell us why you decided to start this? I know that you're an emerging manager, right? Mm-hmm. So can you talk a little bit about why you started it, where you see the opportunities in the market, and historically, how has the venture debt performed over time?
Yeah, absolutely. Julia, it's good to see you again. And,
good to see you
on the panel. Likewise, Marty. So I'm one of the co-founders of Sanctum Capital Management. Mm-hmm. I've been in this asset class for a good 20 years, and I've been able to see from this perch how Silicon Valley has evolved over time, both on the venture equity side and on the venture debt side. What's fascinating about venture debt is while there are currently about 1,500 to 2,000 venture equity firms in the US, there's only about 10 regularly performing venture debt funds. And the demand for venture debt, as Zack had mentioned, far exceeds the available supply. So this is a very underserved market when it comes to technology companies seeking non-dilutive or minimally dilutive types of financing outside of venture equity. Even if you went prior to the pandemic and you dialed it back about 5-10 years before all of the hype around private credit, right? Take all that away. If you're a founder of a technology company, you have two options to finance your business. It's venture equity, which is by far the most expensive, And especially as you're growing your top line at 20, 50%, every single dollar of equity you raise can be very, very expensive. The only other option you have is to go to your friendly commercial bank. In most cases, that was Silicon Valley Bank, and you took out a loan against a cash deposit you already had. So as a founder, you're very, very acutely aware of the cost of dilution. And so you're looking for other forms of financing, especially once your company's off the ground. Now, venture debt has began as a true industry around 25 years ago, mostly around venture leasing, and it's gathered steam since then. And obviously in the last 3 to 5 years, it's really taken off. And even then, it's still only a blip compared to venture equity. So what's fascinating about venture debt is that it is a subsegment of private credit. It lends to mid to late stage technology companies. It is priced at a very comfortable spread above any reference benchmark. And the best part of all is that it basically sails through various macro upheavals and downturns, almost as if it was in its own walled garden. And that's a really fascinating piece about this, because at the end of the day, we're lending to technology companies. So you would think we'd be exposed to tech risk, and we're really not. We are a private credit firm and a private credit product, and we're really not exposed to interest rate rises and inflation and impending recessions. On top of that, the loss rate across venture, this goes to your performance question, Julia. The loss rate for venture debt across the last couple of decades has been de minimis, practically zero. And again, the reason for that is we're lending to companies that have already achieved a certain minimum scale. And for them, the equity has already taken all of the tech startup risk. So the venture debt that comes in is merely an accelerant to a business that's already formed and that already has a very strong value prop. So when I started Sanctum Cap with my co-founder, we had come from 4 different venture debt funds. We understood the playbook inside and out. We understood the best practices, and we walked away realizing that this market was so massively underserved that there could be room for several other venture debt funds, as long as it was led by folks that really understood the upside and the downside potential for this business. Now you bring into factor the pandemic that was sort of a napalm to the industry, especially around software, because the B2B, the B2C industry basically lit on fire. We saw the valuation multiples go into crazy levels. As the pandemic began to cool off and some of those stocks came down, you suddenly saw another burst of VC activity into the AI segment as well. And now you're seeing crazy valuations there. What that has resulted in is a large mass of very good technology companies today that just don't know where to go. So they're up against a wall, right? So you can go to the public markets. We're beginning to see small glimmers of what that might look like now with Instacart and Klaviyo. But a lot is still to be determined. You can't go back to your existing venture equity investors because they're generally underwater. And so the only place to go is non-dilutive, non-mark-to-market capital, which is venture debt. On top of that drop in the SVB accelerant, on top of that drop in the rise in the interest rates, as Zack mentioned, we're floating rate. So as the reference rate goes up, so does the cost of our loans or the price of our loans. So all in all, pretty much every single factor that causes worry on the macro side and on the micro side is actually a tailwind for venture debt. And I'm not just saying it, but I've sort of experienced it over multiple cycles across the .com and the GFC. And it's really incredible that this kind of asset class just sort of sails right through with the predictability that we've enjoyed over the past. I'll just take a quick pause there, Julia, if I've answered your questions.
Thank you so much. I want to go back to Bill for just a second, and following our supply and demand theme, what do you see, when companies come to you these days, what do you see? What are they looking for? What is the market environment like? What are the terms like, deal terms these days? Can you give us some color?
Difficult. Okay. How it is. If you are a company maybe with 20 million in ARR and you're close to break even and you have a good product, okay, that's one bit, as long as you're reasonable on valuation. If you are a company that's pre-revenue and you've got a great product and your last round, we had a case, the last round was 350 million. They're raising their A2 now at 49 million. So a slight drop, if you might say.
Whoa.
And they're very delighted that they could raise 5 million at that rate so far. So that's an example of how things can go. We have other startups that are in the healthcare pre-FDA, and the pre-FDA people are just waiting, say, come back when you have FDA, which means how are you going to go to FDA without cash? So that is a quandary. So unless you're in AI and something very, very hot on the cusp, it is really difficult. So the demand is there, as the supply is not. If you're a small company with 4 million, 5 million of revenue of EBITDA, and you're looking to sell, if you're reasonable, you'll find lots of buyers at that, as long as you're reasonable and don't have untoward expectations. Some of our clients do have untoward expectations, and it looks like they'll be working for 5 more years. I hope that answers some of it.
And when you say 5 more years, is that what you see kind of the cycle that we're writing out?
Yes. We have one lady, 4 million of EBITDA. We had 5 buyers at a slightly under $20 million. Everything's great. Oh, I saw a friend of mine who got 30 million. I want 30 million with no other rationality. To get the 30 million, she's got to grow her EBITDA. And that's going to take her 5 years. And that's when the cycle may be more favorable for her anyhow, to answer your point.
Oh, okay.
So, as long as you're flexible, you might get money.
Okay. Let's now look at the allocator side of the equation. Are allocators attracted to venture debt? Are they, is there demand for venture debt fund, to invest, to allocate to venture debt funds? Is it a great investment? Let's go back to Zack. Let's go back to you. What are your thoughts on that side of the equation?
It's a great question, and I think there's a disconnect between perception of venture debt and reality. The reality is that it's actually got the best risk-adjusted returns of any alternative asset class over the last 20 years. I used to be an allocator, so I've done this research. That's why I got into venture debt, because I saw this was a huge opportunity. Because not only are you getting close to 20% all-in return with a good venture lender when you count the debt and the equity, but you're also getting very stable returns at a very low volatility, because you're getting that fixed. You're getting that coupon that you're getting paid usually on a monthly basis with most venture loans, not quarterly. So you get this consistent monthly coupon. It's floating rate, so when rates go up, you make more money. You don't lose money like you would with a fixed rate security. It has so you've got very low volatility, which people often factor into their risk models, right? That's one of the main metrics people use to quantify risk. So you've got low vol, you've got low correlation to other asset classes. So when the market's whipping around every day, like you're a venture lender and you don't care, because your performance is almost like a straight line, right? With this upside at the end. And so you've got low vol, low correlation, steady income, upside return, and most importantly to me is low drawdown risk. I've always felt like vol was overrated as a risk metric, because I don't really care as much personally if an asset's volatile, as long as it makes me money in the long term, right? But what I do care about is actually losing money. And as Shant said, it's really low default rates that you get with these loans, and the recovery rate is actually very high. And so the historical losses are actually very low, less than 50 basis points a year. In fact, that's a conservative estimate. They're probably closer to 25 basis points per year, going back 2 decades. So anyway, the reason I mention all those things is that's why allocators really should like this asset class, because it fits everything they're looking for, and it goes right into their private credit bucket, right? But they get so different allocators. Sun Life was huge when we worked with a bunch of pension funds. So you could think of us in many respects as managing like a giant pension portfolio, and I mean, essentially it had the same types of characteristics, and you know, that we would like something like that because it's got all these characteristics that we're looking for. Now, the reality is, depending on the type of allocator, it could go in a private credit portfolio, it could go in an absolute return portfolio, it could go in a liquid portfolio, because most of these are you know, there's publicly traded BDCs, of course, but if you want to get into a private fund, they're usually 5 or 6 year lockups with a drawdown structure, you know, similar to a private equity or VC fund. But what's great is you're getting paid to wait. So when you get into a VC fund, you've got a big J curve. You're basically, you know, paying out capital and not making any money for 5 to 7 years, whether it's VC or private equity in many cases. With venture debt, you put in your money, you know, if the fund's already been ramped up, you're getting a check back like a month later, you know, as these companies pay interest, you know, and so you're getting that money in the interim, and then you're hoping, and in many cases getting exits that have a lot of upside through the equity warrants. So that's why allocators should like them. And what I found, and you know, I'm raising fund 1 as well, right? So fund 1 is always tough. It's even tougher when it's an asset class that people don't know. It's even tougher that when it's something that's like innovative, that's like outside their comfort zone. And it was incredibly hard during the peak of the pandemic because you couldn't take in-person meetings, right? And look, no one's writing me a $10 million check because I'm having a Zoom with them, but I tell you, when I get in the room with them, they do, right? And so the difference is, what I'm seeing now in real time is we're getting an immense amount of traction because private credits become more popular. People are realizing that all these speculative investments that made them money in 2021 are now like literally blowing up in their faces, right? Like all the stuff that they thought was easy money is now, you know, easy losses. And what goes around comes around. So now they're looking for safety. They're looking for profitability. They're going back to a fundamental approach to investing. And where I'm really seeing the strategy resonating in the allocator community is with RIAs and large family offices, single family offices as well, but they love it because who doesn't love, you know, 15 or 16% yield with equity kickers, with cool deals that you cannot get access to on the equity side because they've already been filled. But now you can, you know, get in on the debt side, have a lot less risk, be senior to all those VC funds, like literally be senior to like Andreessen Horowitz and Kleiner Perkins and Sequoia. They're beneath you in the capital structure. You're getting paid before they do. And to be able to get into those kind of deals with great growth potential, and then be able to talk about that too with your friends, and they're like, hey, what are you in? Well, I just lost all my money in NFTs. I lost a bunch of money in crypto. You know, I got blown up in fixed income securities because I didn't, you know, hedge my rate risk. I wasn't in the big 7 stocks this year, and so my S&P performance has been flat, right? Like that's the conversation that's going on at the golf course. And if you're like, oh, you know what, I clipped 18% in venture debt last year, and I've got upside on top of that, that's pretty exciting. And so we're seeing a ton of demand from registered investment advisors. Their clients love it. If you can give a high net worth individual a 12% net return with almost no vol and low correlation, and give them equity kickers and a good story, not only do they love it, the reps that work for RIAs love it, because now they have a reason to call their client with something that's differentiated and interesting. They're not calling with the same old, like, hey, I got a commercial real estate deal. Like I got multifamily, I've got an opportunity zone fund. I mean, that stuff is, no offense to people that do it. Hey, it needs to be there, but they're a dime a dozen. There's, you know, 500 funds that I know that do those same things, and they're not that interesting to clients at this point, especially with commercial real estate going up in flames or about to, and, you know, residential at, you know, peak prices with rates high. I mean, there's like real estate is not hot right now, and it shouldn't be. And the number 1 or the number 2 private asset class for RIAs and family offices is private credit. You know, you basically like start in real estate. That's your gateway drug to privates. You're like, oh, hey, I've never been in alts. What do I do? Well, real estate's easy. I understand that it's got these assets and collateral. You know, everybody does it. Then they figure, well, why am I getting 8% in real estate when I can get, you know, 12% in direct middle market loans? And then they figure, well, why would I take 12% in direct middle market loans if I can get 16 in venture debt? And that's literally how the thinking goes. And so we're now far enough along in the cycle, in the maturity of this asset class, where people are finally getting to that stage where like, okay, I did real estate, I did direct middle market loans and bank loans. Now I want something better. What's better? Venture debt. And that's why we're seeing massive traction right now.
I just need to jump in we have a couple of questions here, and by the way, we have about 10 minutes left before the next speaker, or 15 minutes. But what's the duration on these venture loans?
Well, technically the duration's zero because there's zero interest rate risk because they're resetting the rate every quarter typically. But in terms of maturity, most of the loans at outset are 3 to 4 year maturities. Historically, most got paid down in 2 to 2.5 years, looking at 20 years of BDC data. I expect in this part of the cycle, those loans will extend to further out. In other words, they won't be paid down early in most cases, because why would you do that when capital is expensive and hard to come by? So most of these loans will be 3 to 4 years over this next part of the cycle.
Sure. I mean, there's a lot of bridge lenders who are doing 18 to 36 months, but we had another question, Gary.
Yeah, so, well, first of all, I want you to know that, I've got to see the Seminoles lose because, USC will not get to the CFP if they don't lose and the Longhorns lose. So I'm actually going to be a big fan of that game, but whenever it's played. So, but one of the things I look at is the Business Development Corporation. So they're public, the public ones. And so, it's a good opportunity because you can write options on it if you want to try to extend your thesis. But what I noticed in a couple of them, I had a classmate from school. He just sold his Brookmark Capital Corporation, and he moved it into Ready Capital. And what he was doing on some of them, they were financing like raw land and stuff on development. It seemed like those were getting away from ready cash flow positive ones. So what do you think of the public ones? Because you can pretty much look into them pretty good. And is there some tips there? And also do you get into some more speculative areas of venture debt?
Yeah, I can take that. Yeah, I can. So on the publicly traded BDCs, if you think about BDCs across the country, there's about 55 of them. And venture debt BDCs tend to be the best performing of all BDCs. They are a very good source of research and intel, and can certainly give you that historical loss rate data quite easily, and you can actually peer directly into their portfolios. The difference between the publicly traded BDCs and what a private credit fund like what we're trying to do is that obviously you get a lot of liquidity with a BDC. You can buy the stock and earn the dividend and sell the stock whenever you want. But on the private side, you're actually able to get at least 2x the type of return that you would get from a public BDC. So an important thing to remember is a public BDC is typically levered by its very nature. So it could be levered as much as 2 to 1, 3 to 1. So if you apply the same kind of apples to apples math to a venture debt fund that's private, you're going to get into the 20-ish type of returns. The best performing public BDCs generally around I want to say roughly around a 10% type of dividend yield. So you're getting that illiquidity premium for holding the private stock. In addition, with a private fund, you also get access to interesting co-investment opportunities. You get to look at direct equity investments that are sitting inside the venture debt fund, none of which you would enjoy with the public BDC. So I think it's sort of a toss-up, not a toss-up, but a cost benefit or a benefit disadvantage type of argument to be made between a publicly traded liquid structure versus a private one.
Now, how about the secondary market? If you wanted to get out of one of those early, what's the secondary market? Because this guys, things happen, divorce, death, some family
Good
issues.
point. I've got 2 quick thoughts on this, just to build on what Shant said. One thing is, if you want to look at the performance of venture loans, there's an index called the Cliffwater Direct Lending Index, and I put this in the chat. So it's called the CDLI. So Cliffwater is a very well-known consultant, and they've been tracking middle market loan performance, I think back to 2004, if I'm not mistaken. We can check the exact dates. But the takeaway is they actually have a sub-segment now, a separate index for the venture debt-focused BDCs. And what's amazing to me, well, I knew this, Shant knew this, we know this, but what should be amazing to other folks is that the yield pickup at equivalent or lower risk on venture debt loans compared to non-venture direct middle market loans is over 325 basis points. So it's the yield that I put in the chat, it's 14.5%. These are, again, the public BDCs that you can buy stock in, and direct middle market loans in that same index that are not venture yield 11.2%. So would you rather have 14.5% or 11.2%, right? And also in the venture loans, you also get, I think, better diversification, because they have less correlation, although it's hard to prove that. But and the last thing I'll mention on the BDC side is the BDCs are good. I mean, they're good at underwriting. The issue with the BDCs, in my view, is that if you buy a BDC stock, public BDC, they have a lot of market beta risk. So when the market sells off, most of the BDCs trade with a beta of about 1.5 to 2 times, meaning they're 1.5 to 2 times more volatile than the market. So if you go back to April 2020, if you want to see exactly what I mean, look up Hercules Growth Capital, which is the biggest non-bank venture lender in the country. Great underwriter. They've got loss rates less than 10 basis points a year going back 20 years. So I have nothing bad to say about their underwriting, but I will tell you, look at their stock performance. It was down, I think, 60 or 70% in April 2020 because the market sold off. They're a high beta stock. People get scared and they sell, what they can. And imagine if you had put, $100 million as an allocator into Hercules because you like venture debt, and the next month it's down $70 million. You're going to be out of a job. Now, here's the key takeaway. The underlying loans in Hercules' portfolio, as well as across the venture debt space, never got hit, performed brilliantly over the last 20 years, but including that part of the cycle, right? So if you were in a private fund like A.R.I. or Sanctum or WTI, which used to be private, or Oryx Growth Capital, or a whole host of others, you would not have had a markdown, and so you would have been looking pretty smart in April 2020 when your peers that wanted, quote, liquidity were getting blown out of their jobs. So I think that's a really important point if you care about career risk.
Very cool. So why don't we go, I have so many more questions for you, but I just
about 5 minutes.
Oh, great, Marty. Well, thanks.
Yeah.
In that case, why don't we go to closing statements? Bill, let's start with you. What would you like to, is there a summary that you would like to close this panel with?
The only summary I would think of is when you hear from an investment bank, he's there to sell you something that you would not otherwise see, and you might open the email just to see if that's an investment that might be interesting, especially if they're FINRA regulated.
Fabulous. Thank you so much. Shant, let's go to you.
Yeah, so we've talked a lot about venture debt and the macro and the micro. I think I'll just leave you with this. 2023 promises to be a fantastic vintage for venture debt, and for many, many reasons that we've already discussed. One interesting thing that we haven't touched on too much is that when you're a lender to technology companies, you learn a lot about those companies, and you're top of stack during an uncertain economic environment. It's a great place to be. You're earning above a nice spread above the index. But on top of that, you're accumulating a basket of warrants priced at a very low valuation. So we're currently in a sort of a tech valuation valley, so to speak. And so picking up warrants priced at today's valuation means that as you emerge out of this valley over the next couple of years, you suddenly have some very nice pool of options that will accelerate and add to the overall return of the fund. So it's a great time. Even if we were doing 100% debt with no warrants and no equity, it would be great. On top of that, a nice sweetener is that we actually get warrants in these companies. We have the ability to make direct equity investments into their next round. And I often see today, in fact, I saw a deal just yesterday where the company was very reasonably priced, great business, a great opportunity to pick up warrants alongside the debt investment that we're about to make. So I'll just leave with that. It's a fascinating place, and I'll put my information in the chat.
Hey, Julia, I got a quick question for Shant. So just give me a second here. Shant, do you ever sell those warrants, or you hold on to them? I mean, do you sell them before the fund is refunded to the investor, or when the fund matures, do you sell them, or do you hold on to them long term?
Yeah, we usually house the warrants in a separate vehicle, and typically the warrants have a longer duration than the life of the fund itself.
Right.
In which case we open it up to the LPs. We can either distribute the warrants and split up the shares, or it simply sits in a separate vehicle and is liquidated over time.
Interesting. Yeah. Fascinating.
Am I the last to go?
Yeah.
Well, first I want to say thanks, Marty, for having me on, and thanks, Julia, for hosting. And thanks, Shant and Bill. Bill and I had a great conversation offline, by the way. You didn't talk a lot today, Bill, but man, you know your stuff, and I would love to do stuff with you offline. And Shant is great in venture debt. He's one of the most experienced guys in the space. Everything he said on this and at other times, like I've read your stuff, I've seen what you've been doing, and I'm really impressed. So just very impressed with everybody here. And Marty, you also always have great guests that always ask good questions. So it's I'm always thankful to be invited. So thank you. The only thing I'll add is, I think, Shant nailed this, but it's really this is the opportunistic time to get involved in venture debt. People always want to get in at the right time. So it's not always about just the underlying product or the asset. It's really about timing is everything. And there couldn't be a better time. Like I literally have goosebumps right now just thinking about it, because 2023, 24, and I think even 25 are going to just be outstanding vintage years. And I just don't think it's going to get any better. Like I couldn't have timed a better opportunity to bring a fund to market, to have a clean balance sheet and go out with fresh capital and be selective with the plethora of opportunities out there. It's like fishing with dynamite, right? I mean, it's crazy. And I truly mean this. Like, I could be doing a bunch of things in my career. I choose to do this because I want to. I feel like this is the big opportunity. And I just think it's a huge opportunity for investors. And the last thing I'll mention is, look, I don't think you have to pick like one venture lender. Like people often say to me, like, why should I invest in you and not Hercules? And I'm like, you shouldn't do either. You should invest in both. In fact, what you should do is take a percentage of your portfolio, 5 to 10% is kind of what I would recommend, and put that, diversify that across, 3 to 5 managers, a couple public and a couple private, right? Then you're going to get a diversified return within venture debt. So I think of it as diversification within diversification within diversification. So you start out in alts, then you get into private credit, then you get into venture debt. And then within venture debt, you diversify. You throw in some Hercules and maybe some, Horizon or Runway in your public BDCs. And then in the private side, you talk to Shant at Sanctum, you talk to us at A.R.I. Maybe you go with a bigger private lender, although there aren't that many. I mean, their access is limited. And now you've got 5 potential winners. You're well diversified, and you're likely to get to that mean return of a 15 to 20%. So I'll leave it at that. Like nobody needs to be the best. Just be smart, diversify, and diversify across stage, sector, region, public versus private, and you're going to come out a winner. Like I will bet my reputation that venture debt holistically amongst the better managers is going to kick ass over the next 5 years. Like, I don't know, you might think A.R.I. sucks. I don't care, but venture debt is going to kick ass, and you should be invested.
So I just want to kind of frame what Zack is saying right now. I get countless phone calls from people who are in Series C, and they just can't find an investor. Series C, Series D, Series E, they're just dead, right? They're all looking for some kind of strategics to bail them out. But for those who are going to get funding, it's going to be less funding than they anticipated, and they have to make it up with venture debt. There's just no other way around it. So that's, I think, the opportunity. And by the way, this group has been into alternative lending for years and years and years. I mean, we were into hard money lending before 2008. Hard money lending had some problems in the courts post 2008. A lot of us got into peer-to-peer lending, and a lot of us did venture debt because of Tom Niehaus, who couldn't make it today, back in 2009. So, I think it's a super interesting space. I do like other debt products, but this is a market which is highly fragmented because SVB is out, and because Hercules is, Zack, did you say it's 10% of the market?
Hercules, it's probably a little bit more than I would think now, but yeah, you could say like 10. Yeah,
so it's fragmented, and it's most likely that every all these smaller players that you meet have their own specialty and focus, which doesn't overlap with other ones. So great job, guys. Thanks so much.
Thank you.
Thanks, everyone.